Welcome back to Inside the Wall. In this episode, we aim to perform M&A signal analysis focusing on Netflix and Paramount's bid for Warner Bros. Discovery assets. First, we will deconstruct the strategic intent behind this significant bid by examining the strategic posture and market signals of the involved parties. Each party in this deal is playing from a very different strategic position. Netflix is framing its move as opportunistic, not defensive. Management has been clear. They're happy with organic growth, didn't expect this asset to be available, and see the deal as future-proofing for decades. That's classic optional buyer positioning, signaling they can walk away if terms aren't right. Warner Bros. Discovery sits in the middle. By initially agreeing to Netflix's offer while Paramount was also circling, the board signaled it viewed Netflix as the better path for shareholders. But Paramount's public counterbid now forces Warner Bros. Into a defensive stance, requiring it to justify both its decision and its process. Paramount, meanwhile, is acting with urgency. By appealing directly to Warner Bros. Shareholders and attacking the Netflix deal as inferior, it's signaling a forced buyer posture. This isn't about weakness, it's about necessity. Paramount believes scale is essential to survive in streaming, making this deal strategically compulsory, not optional. The financing contrast between these bids is stark. Netflix emphasizes discipline, committing to maintain its investment-grade rating and rapidly pay down debt after the deal. Paramount, meanwhile, is selling certainty. An all-cash offer fully backstopped by committed equity from the Ellison Family Trust and Redbird, plus debt financing from major banks. Paramount's core attack on Netflix centers on risk. Netflix's proposal relies on non-cash consideration and a spin-off of global networks, leaving shareholders exposed to uncertain stub equity value. Strategically, Paramount is framing its bid as safer and more predictable, appealing directly to shareholders who value certainty over potential upside. Netflix's M&A philosophy tells you a lot about how it sees this deal. Management openly admits it lacks experience in large, complex integrations, but frames that as consistent with Netflix's history of mastering new models. Importantly, this isn't a defensive move. Netflix calls it an opportunistic acquisition from a position of strength. And unlike rivals focused on deep cuts, Netflix emphasizes growth over slash-and-burn synergies. While it expects $2 to $3 billion in cost savings, those come mostly from SG&A and overlapping tech, not creative content. The message is clear. Value comes from strategy and scale, not aggressive consolidation. The biggest risk in any mega deal is integration, and Netflix has been unusually candid here. Management openly admits it lacks experience with large-scale M&A, which raises execution risk. Its plan is a light-touch approach, integrating assets, not collapsing Warner Bros. Studios into Netflix's organization. That may reduce short-term disruption, but it risks leaving silos and delaying real integration, limiting long-term synergies. On top of that, the deal forces a major cultural shift. Netflix is now fully committing to theatrical distribution, a sharp pivot from its streaming-first roots. Together, these factors make integration the deal's most fragile point. In summary, deal risks include regulatory and value uncertainty due to the mix of assets and volatile stock. Execution risks include integrating a theatrical studio and linear TV business, which are outside Netflix's core competency. Let's now turn to Paramount Skydance's hostile offer, taken directly to shareholders. The offer is simple and aggressive: $30 per share, all cash. That implies a $78 billion equity value and about $108 billion in enterprise value, assuming roughly $30 billion in net debt. It's a massive 139% premium to Warner Bros.' undisturbed share price. The key advantage is certainty. Warner Bros. Shareholders get fixed cash at closing, unlike the Netflix alternative, which mixes cash, volatile stock, and uncertain spin-off equity. Paramount's management says it plans to regain investment-grade metrics by 2027, which will depend entirely on fast synergies and strong cash flow to delever after closing. Thank you for watching this video. Please leave us a comment with your thoughts and questions.